I think 2017, I would say, is a very interesting year for venture and entrepreneurs because a lot of lessons were being learned in the last 2-3 years. What works, what is the market size. Before it was a hunch. How big is the Indian internet market? Okay? How big is the Indian consumer market? How much are they willing to spend? In 2013-14 was a hypothesis, okay? It was a thesis. Okay? And we know how it played out over the last 3 years. Okay? And now people have, there's a thesis, now there has been some actions, now we know the results, right? So now there is a reset of those theses. Okay? Look, Indian consumer market is not going to grow to 100 billion, 150 billion in by 2020. Okay? It's going to be more like 15-20 billion. Okay? So it's a factor of 5. Okay? So that is a big learning, okay? Both from the venture side or the private equity side, and even on the entrepreneurial side, right? You can't just buy your way. So if the market is 20 billion, we can't just push our way to 100 billion by incentivizing people, because there's always you'll bite. Okay? If you don't want to buy something, I can throw you a 50% discount and to make you buy. Okay? But then it'll go away tomorrow. It's not real, right? So the entrepreneurs also learn that's not a way to build business. You got to have a loyal following. You need to build the business such a way that there is a brand consciousness. People like buying your product because it's of high value. So these two things have been learned. Now, 2007 is an interesting year because all these new learnings, the entrepreneurs and the ventures are now investing to the new thesis, okay, which is updated thesis. Okay? So I think it's an interesting year. It's probably a very good year because we call it like any wine, right? Wine has got a vintage year. Every 3 years, 4 years, the soil is great, the sun shines better, there's no rain, good time to grow grapes, get good, same thing. It's got a perfect combination of all the ingredients to make vintage year for. So I would say if I am a VC, I'll put more money this year. Okay? We'll get the best deals for the next 18 months. After 18 months, the bubble will start again. Well, people forget. So people have a very short-term memory. 3 years, they forget what happened and they'll repeat the same mistake. Okay? So 18-24 months, the bubble will build up, price will go up, and that'll be too late. Okay? Then you have to wait for a correction again. It's the best 18 months. I think the entrepreneur should know what he's capable of building. Okay? So you can't go by hype. Okay? So let's say I'm selling mobile phones, okay? And I'm building a company selling mobile phones. I really know how many mobile phones I can sell, what is the market size, who are my competitors. Okay? There are 10-20 competitors all cutting price. I can't say, look, I'm going to grow the business to a huge size because I'm going to throw money. So you got to size the market, you got to size your competition, then you got to project, look, how much I can grow. Okay? And there is a limit to it. And you take money only what you can grow, right? You don't take money is available. Okay? Sometimes money may be available. Okay? So what happens is, that's what happened in the last 2-3 years, money was available. So entrepreneurs took maybe 10 times more money than they actually need. Okay? But there's a price for it. The price is, I'm not giving it, nothing is free in the world. If I'm taking 10 times more money, I have to return back to my investors 50 times that, at least 5 times that. So I got to return 50 times the money. Okay? Now, can I build my business to return 50 times? The answer is no. You got to burn. You can kill a good company quickly. Okay? And that's what has happened, right? So I think good entrepreneurs should think through this very well. If I take 1 rupee, can I return 5 rupees back to my investor? Okay? Or 10 rupees, okay? Depending on the investor stage, it's 5 to 10. And be conscious about it. Right? See, we are a late stage investor, which means we put in at least, minimum we rate is 5 million and go up to 50 million into a company. That means we can do Series A. So we look at it as deal flow. So to get to a company to Series A stage, there are only 2 ways to do it. Either the entrepreneur is a serial entrepreneur, he's built companies before, so then he can raise Series A. If you're a new entrepreneur, you got to work with family and friends, seed funds, angels, to build your company. I'm not saying it has to be big, certain size. So we look at it as deal flow. So why do we come here? Is to see all the companies which I may not fund them tomorrow, but we keep track. Okay? Yeah. So we like to know what is happening, what is the trend, what is the trend in the ecosystem, how many companies are getting funded, who they are. So it's basically we call it the pipeline building. Okay? So very early, some investors I've seen, quite a few of them, they actually write small checks, $500,000, $1 million. For them, they can co-invest with angels. Okay, for them it's great, perfect, because they come here, see a lot of deals, they can write $500,000, $1 million and go. There is no formula to predict at early stage which is going to be successful. Okay, that's period. Okay, somebody claims they know, they're going to fail the next time. Okay, there's no formula, and that has been proven over the last 50 years. Okay? So if you find all the great companies, they would have struggled. So the only thing I can say is, if nobody funds them, company is struggling. As a VC, I have to look hard, okay? Because that's the only common thing, right? The companies which never get funded, companies taking long time to get funded, are actually therein lies the future winner, okay? Not if 10 VCs or 10 angels agree, it's a great company, they all want to fund. At that stage, early stage, there's a 99% probability that will fail. Okay? So I think the earlier everybody understands that, okay, you're better off, because you look for, if everybody is agreeing to, okay, this is a great thing, I actually back off now. Okay? There's something wrong. Why is everybody agreeing? Then it's too obvious. Okay? So the major disruptions will come from unknown sides. Okay? People will be blindsided always. Okay? See, that's why I said you can't build a next Facebook now. Okay? I can't be running around saying I'm going to next Facebook will be something else. Okay? Nobody will know. Okay? Having said that, we look at the energy level of the entrepreneur. Okay? He has to be high energy. Okay? High energy, passionate. These are all more subjective. Okay? There is no objective metrics. Okay? But we like, that's important. Okay? We don't want people, okay, to come in and say, look, I'm forming this company because it's the next big thing. Okay? We want to avoid those people. Okay? So that's one of the screening process. Is this person jumping in because this is hot area and I want to ride that wave? We don't want them. We want really people who believe in that idea. Good or bad, they'll live through it. Okay? So that's probably a judgment call. Okay? That's probably the only thing you can judge at the time. Okay? It's going to take time. Okay? So the venture model is a 10-year model. India has a 15-20-year model. Okay? So it's not going to happen. Which means you start a company now addressing that it's going to take 15 years to mature. Okay? It's not 2 years, not 3 years, not 4 years. So you need patient capital. Okay? And the 10+ model will not work. Okay? So I think VCs and investment managers have a 15-year view. It's a great thing to do now. I think it's great because long companies are not built overnight. They take time. And India, I think, a little bit longer. Right?